Welcome to today's explainer. If you're the kind of person who really likes to peel back the layers and understand the hidden mechanics behind major financial commitments, well, you are absolutely in the right place. Today, we're unpacking a highly specific, honestly critical real estate policy from Nationwide Real Estate Acquisitions LLC. We're going to map out exactly how they manage risk, protect assets, and structure their agreements so that virtually nothing is left to chance. We've distilled all their core requirements so we can understand exactly what this mandate is, and more importantly, why it actually matters. It's kind of the ultimate puzzle in real estate, isn't it? When a property changes hands and a massive financial commitment is made, how in the world do you safeguard a mortgage against the totally unpredictable nature of human life? It's a high-stakes scenario for literally everyone involved. And the policy we're looking at today? It answers that exact question with a very strict, highly structured framework. Okay. Let's dive into this. Section 1. The 15-year mandate. So, the magic number here is 15. For buyers who are sourced through Nationwide Real Estate Acquisitions LLC's agent network, getting a 15-year insurance policy isn't just some friendly recommendation. Nope, it's an absolute requirement. You might be wondering, why 15 years? Well, it's because that time frame specifically covers the most financially vulnerable early half of a standard 30-year mortgage. This mandatory measure is really the bedrock of their whole risk management strategy. Think of it as the definitive tool designed to prevent property loss. Basically, you simply don't get the mortgage without this 15-year safeguard securely in place. Section 2. Safeguarding against life crises. Now, what's really interesting about this approach is how it takes this abstract idea of risk and grounds it in stark reality. It explicitly targets 3 unforeseen hardships: job loss, physical disability, and accidental passing. I mean, let's face it, human life is incredibly chaotic, right? It rarely goes exactly to plan. One minute, you're picking out paint colors for your new living room, and the next, everything just turns upside down. Nationwide Real Estate Acquisitions LLC recognizes that life happens. So this mandate isn't just bureaucratic red tape, it's a very real safety net designed precisely for the moment the unexpected hits a buyer. So the crucial point is continuous coverage. When a purchaser faces one of those devastating crises we just talked about, the policy kicks in to keep loan installments consistent. That is the ultimate goal here. It essentially stops the domino effect. By keeping those payments steady, the policy prevents the ultimate tragedy in real estate, which is property loss. It creates this critical firewall between a personal hardship and a total financial collapse regarding the home. Section 3. A mutual protection agreement. This mandate actually bridges the interests of both parties perfectly. Yes, obviously the buyer gets that vital continuous coverage safety net during a crisis. But looking at the other side of the transaction, this mandatory policy gives the private seller direct protection from the immense complications and, quite frankly, the headaches of foreclosure. By preventing the buyer from defaulting during a hardship, the seller's interests are completely preserved as well. So it's not just a one-sided safety measure, it's a dual shield for everyone. And this brilliantly illustrates the core philosophy of this mandate. It is, in the exact words of the source, a mutual protection agreement that stabilizes the financial relationship between both parties involved in the transaction. It acknowledges that the buyer and the seller are financially linked. A crisis for one is a risk for the other. By mandating this 15-year safeguard, Nationwide Real Estate Acquisitions LLC is essentially engineering stability right into the very foundation of the deal. Section 4. Executing the claims process. Breaking down the chronological flow of this policy reveals a tightly controlled logistical process. First, right at the beginning, before the close of escrow, the home buyer must provide actual purchase proof of this insurance to both the home seller and the note buyer. It absolutely has to be verified upfront. Then, moving forward on an ongoing basis, the cost of this insurance isn't some separate, easily forgotten bill. It's actually directly rolled right into the home buyer's monthly mortgage payments. Finally, the trigger. If a hardship actually occurs, a claim must be filed strictly within 30 days. There is zero room for procrastination here, ensuring there are no gaps in protection or awareness. Let's move to and see how this builds into the actual claim sequence. Step 1. An unforeseen hardship, like a job loss or disability, happens. Step 2. As we just saw, the home buyer must act quickly and file that claim within the 30-day window. Now for Step 3. Why that strict 30-day window? Well, it's specifically mandated to give the insurance claims adjuster the necessary time to do their due diligence on the event. They have to verify the hardship. And then, Step 4 brings the resolution, where retroactive payments are issued. I actually want to pause for a second and emphasize the final result of this entire process. Because of that quick 30-day filing and the adjuster's due diligence, the system is designed so that all parties receive retroactive payments from the insurance company. This safety net doesn't just stop future financial bleeding, it literally reaches back to cover the gap caused by the hardship. The buyer doesn't lose the house, the seller doesn't face a massive foreclosure mess, and the financial relationship remains perfectly stabilized, exactly as intended. So, we've just walked through a highly structured, unyielding mandate. A 15-year policy rolled into monthly payments, strictly requiring 30-day claim windows, all to create a mutual protection agreement. If this level of mandatory safeguard from Nationwide Real Estate Acquisitions LLC can successfully stabilize a mortgage against life's worst unpredictabilities, how might this exact model of shared, continuous protection reshape the wider future of private real estate transactions? It's a genuinely fascinating concept to consider as we think about how we manage risk in our own lives. Thank you so much for joining me today for this deep dive into the mechanics of mortgage safeguards. Keep learning, keep asking questions, and I'll see you for our next explainer.